Pause. This matters. Because the headline today is simple. Chinese billionaire shorts silver, makes a fortune. But the real story isn't a villain. And it isn't a hero. It's plumbing. It's leverage. It's structure. And if you trade silver like it's just a shiny rock with a chart, this is exactly how retail accounts get chopped up. So here's what I'm going to do. I'm going to walk you through what I saw, what I checked, what I could verify inside the last 24 hours, and what I cannot. And by the end, you'll understand the one thing that matters more than the headline, where stress shows up before price. Here's the cliffhanger question. If one trader can be positioned this big on paper, what happens when the market goes the other way and the margin clerk shows up? Welcome to Market Desk Daily. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. Subscribe right now because this is the kind of analysis you will not find anywhere else. Now, stakes, brokerage reality. This is where people get hurt. Silver is not gold. Silver is gold, with a turbo strapped to it. More beta, more leverage, more positioning games. So when silver moves, it tends to move more than gold, not because it's more magical, because it's a smaller market, and it's traded with more leverage and more emotion. And that's why this story matters, even if you never heard the name Bian Shiming in your life. Because the headline tries to turn this into a personality, but the mechanism is the same mechanism that hits your account. Let me hit the elephant objection. You might be thinking, okay, cool story, a billionaire traded futures. How does that affect me? Here's how. When a market gets crowded and it's built on leveraged paper claims, you don't need bad fundamentals for a crash. You need forced selling. You need margin. You need the exit door to get small. And recently, Reuters described silver volatility like a classic snowball. Stops, technicals, momentum flips, and suddenly the move feeds itself. That's the important translation for you. If you're leveraged, you can be right long-term and still get wiped short-term. Now, core thesis. This move is not just price. It's a fight between paper leverage and physical constraints. And stress shows up before headlines. Everything we say today plugs into that. Paper leverage versus real-world constraints. And stress shows up in the plumbing first. So here's my three-part framework. Simple, actionable, no hype. Part 1. Separate the story from the structure. Part 2. Understand leverage mechanics, margin and liquidation. Part 3. Watch stress gauges, not vibes. Let's start the investigation. I saw the story making the rounds. Bian Shiming, gold winner, now a silver bear, $300 million shift. So I asked a basic question. What can I verify inside the last 24 hours? And here's the honest answer. Inside the last 24 hours, what I can see is mainly republished summaries repeating the same core claims, often attributed to Bloomberg-style analysis or unnamed sources. So if we're being strict, the exact position size and profit math are. Still, the setup is worth studying, because whether it's one guy or 10 desks, the mechanism is the same. Here are the claims that are circulating. That a discreet Chinese billionaire trader, based partly in Gibraltar, made billions riding gold futures, then built a major short in silver through Zhongkai futures on the Shanghai Futures Exchange. That the size is roughly hundreds of tons, tens of thousands of contracts, and that the pullback created a huge paper profit. Now, my job is not to worship it. My job is to translate it into what can break next. Because here's the trap. Retail hears this and thinks, so, I should copy the billionaire. No. That's how you donate to the market. The billionaire isn't trading your account. He's trading margin terms you don't have, liquidity you don't have, and sometimes information timing you don't have. So let's talk leverage in a way you can feel. Here's a generic margin example. Not market specific. Say you put $10,000 into a leverage product at 10.1. You control $100,000 of exposure. If the price moves against you by 10%, your $10,000 is gone. And you won't get a friendly phone call. You get a forced sale. Right into the worst moment. That is liquidation. That is the margin clerk. And the margin clerk does not care about your thesis. Now, apply that to silver. Silver tends to move harder than gold. So leveraged silver is basically margin roulette. And that's why silver often looks like it's acting crazy, while gold is acting boring. Gold is bigger, deeper, more insurance-like. Silver is smaller, more speculative, more positioning sensitive. That's plumbing first reality. Now, paper versus physical. This is where people get confused, because they think futures equals metal. No, futures are claims, they are contracts, they are leverage containers. Physical is bars in a vault, coins in a dealer network, and industrial demand that can't be printed. And when paper gets crowded, the unwind can be violent, even if physical is tight. Do I have verified last 24H data on lease rates, spreads, delivery tightness, or dealer premiums? Not in sources I can safely cite inside your 24-hour window for this specific story. So I'm going to do the honest thing. I'll tell you exactly what I would watch and what would count as proof. Stress shows up first in futures spreads, lease rates, premiums, delivery delays, exchange rule changes, and margin updates. If those start screaming, price usually follows. And Reuters already showed recently that China-linked silver exposure can become structurally stressed, like a fund trading at a big premium, hitting down limits with warnings about valuation and investor protection. That's not gossip, that's structure. Now, back to beyond. Why do people obsess over The Big Short? Because it feels like a movie, a single mastermind versus the market. But real talk, markets don't move because one guy is smart. They move because positioning meets constraints. So here's a cleaner way to think about it. Even if the exact numbers are, the concept is, a major participant leaned against a crowded rally, and the unwind paid. That's not mysticism. That's crowd psychology plus leverage. Let me give you the theater exit analogy. Imagine a theater packed wall to wall. Everyone's enjoying the show. And then someone yells, "Fire." It doesn't matter if there's a fire. What matters is the exit door. Silver is often that packed theater. A lot of paper exposure, a lot of leverage, a smaller exit door. So when momentum flips, everyone tries to leave at once. Here's the adult takeaway. Your risk isn't only direction. Your risk is the chain reaction. Okay, so how do we approach this like adults? Not financial advice. We stop trying to predict the next candle. We build an exit plan, and we watch stress gauges. Here's the discipline sequence. Step 1. Define your role for each metal. Gold, insurance. Silver, volatility and upside potential, but it's not your emotional support asset. Step 2. Size silver smaller than gold if you can't tolerate whipsaws, because silver will humble you. Step 3. Choose your vehicle carefully. The more leverage you add, the more your outcome depends on margin rules instead of your thesis. Now, why this window matters? Because when markets are in a volatility regime, liquidity changes. Bid-ask spreads widen, stops get hunted, and tiny headlines get amplified into giant moves. You've seen enough volatility recently that even mainstream outlets are documenting dramatic intraday swings and liquidation narratives. That's a warning label. Now, one subtle detail that matters in the be-in story. These summaries themselves point out a key limitation. The Shanghai Futures Exchange does not reveal the identities behind brokerage accounts. So treat identity-based certainty as a trap. Focus on what you can observe: positioning behavior, volatility, and the plumbing signals. And this is where I do something most videos won't do. I'll tell you what I would verify next, if I had the primary docs inside your window. I would look for an exchange notice on margin limits, a seat ranking report or daily position data, a regulator note, or a Tier 1 original confirming the contract counts. If it's real, it shows up there, not in memes, not in anonymous screenshots. That's how you stay alive. Now, psychology trap time. Retail sees $300 million bet and thinks, this is certainty. It's not. A big position can be right and still get squeezed. A big position can be wrong and survive because it's funded. Your account doesn't get that privilege. So here's your number one mistake in the fix. Mistake. You oversize silver after it already moved because the story feels clean, because you want the next leg. Fix. You scale in smaller, you accept volatility, and you define the point where you're out before you enter. Here's the realistic scenario. You buy silver because it's breaking out. You add leverage because you want it to matter. Then it drops hard in 2 sessions. You tell yourself, I'll hold, it'll come back. Then you wake up to a margin call and you sell at the low right before the bounce. That bounce doesn't mean you were wrong. It means you were undercapitalized for the vehicle you chose. That is the whole game. So what do we watch next? Watch. Here's my one phrase for levels and confirmation that we use every episode. Line, lane. Confirmation. Line, the level where forced selling shows up. Lane, the range where price can chop without meaningfully changing the thesis. Confirmation, the plumbing signals that tell you the move is real. And since I cannot responsibly claim specific spreads, lease rates, or premiums inside the last 24 hours for this package, I'm going to give you the watch list, labeled honestly. Watch list signals. any confirmed exchange margin or limit updates, any credible reports of delivery tightness or delayed bars, any surge in retail premiums at major dealers, any unusual backwardation or contango moves in near-month futures. If those light up, stress is rising. If those stay calm, price moves can be mostly positioning noise. Now, where does Beyond fit in the one movie? He's not the villain, he's the plot device. The plot is, paper leverage met constraints and volatility, and stress showed up before the headlines. Let's close this clean. Silver is not gold. Silver is leverage sensitive. When the crowd is positioned, the unwind is brutal. The Beyond story, inside the last 24 hours, remains mostly a republished narrative with key numbers but the broader environment shows the kind of volatility and structural stress that makes these big position stories matter. Here's what to avoid. Don't oversize silver. Don't confuse a story with a signal. Don't use leverage unless you can survive the swing. And here's what to watch next. Not vibes, not gurus, stress gauges. Because if the next leg happens, the first clue won't be a headline. It'll be the plumbing. Final cliffhanger. If the crowd tries to re-lever into the next bounce, what's the first stress gauge that will break before price does? If you want, I'll pin a comment with the watch list signals so you can track them. And if you got value here, stay subscribed.